Silver crashed from $120 to the low 70s in a single week. Gold got hammered. The charts looked like someone pulled the floor out. But here's what doesn't make sense. While price was collapsing on your screen, real-world demand for physical metal was exploding. How does that happen? Stay with me, because what I'm about to show you separates people who understand markets from people who just watch headlines. Last week was one of the nastiest shakeouts in modern metals trading. Silver hit highs that had everyone celebrating, then collapsed so fast it felt like a trapdoor. Gold followed. It looked like someone hit the panic button and dumped everything, but the selling is only half the story. What happened on the ground with coins, bars, and premiums tells a completely different picture. This is Con Invests, and we're walking through this step by step. The most important clue isn't the headline price. It's the message hiding behind it. Let's start with hard numbers. Silver ran up into the low 120s, then dropped to the low 70s at the worst moment before bouncing to mid-80s. That's not a pullback. That's a gut punch that wipes out leverage and resets expectations. Markets don't behave the same after something violent. On the worst day, silver's dollar drop was the biggest single-day fall people remember in this era. Percentage-wise, it wasn't the worst ever. That record belongs to decades ago when a concentrated speculative frenzy got squeezed, margin rules tightened, and forced selling cascaded. That day, silver got cut in half. But here's the key difference. Back then, the dollar move looked smaller because starting price was smaller. That's why this latest slide felt impossible to so many. When you start from 120 and drop $50 in hours, it feels like the world is ending. A lot of people noticed that as metals slid, normal circuit breakers didn't seem to catch the move. Futures markets have daily limits that shift by contract and session. But when price dumps, it feels like the system lets it fall because forced selling is orderly to clearing houses. The market survives, not protects feelings. Before we do, keep one thing in mind. Even after this beatdown, silver is still up compared to where it started earlier in the cycle. That tells you something important. The long-term pressure hasn't magically vanished. This move might be a reset, not a funeral. While screen price was crashing, the physical market sent the opposite message. Multiple dealers described a surge in people trying to lock in metal, especially silver. They saw the drop as a rare chance to get in before premiums expand. Some large mints and wholesalers said you're not ready for what's coming. They described demand that reminded them of lockdown-era chaos. This is where you pause and ask, if silver is collapsing, why are people buying it like it's disappearing? That contradiction is the entire game. Paper can move instantly. Physical moves slowly. When paper price collapses faster than physical supply responds, the gap shows up in premiums and spreads. Another clue. Regional pricing. Silver in Shanghai has been trading at a meaningful premium to Western benchmarks. The premium widened as demand spiked. If you can buy something for one price in one part of the world and it's significantly higher elsewhere, that's the market screaming tight supply and constrained logistics. Premiums include taxes, import costs, and shipping. But when they balloon and stick, real metal isn't flowing easily to meet demand. If you're finding value in this breakdown, hit that subscribe button. We're building a community here at Con Invests that focuses on what's really happening in markets, not just headlines. And drop a comment to let me know what you think, because it helps me understand what matters to you. Now the big question, is this sell-off a healthy correction or a warning shot? A correction after a parabolic move is normal and almost required. Markets don't go straight up. But there's a second possibility. The sell-off can be a hunt for liquidity. When that happens, the decline stops. When enough forced sellers are wiped out. The bottom isn't set by logic, it's set by pain. If this was forced liquidation, the rebound can be violent once selling is done. So what should you watch now? Watch whether physical premiums expand. Watch whether delivery times stretch. Watch whether futures spreads behave oddly. Watch whether the gap between regions narrows or widens. Watch whether volatility stays elevated. High volatility tells you the market is still unstable and more moves are coming. Most people watch spot chart and assume that's the whole market, but spot reflects multiple layers: futures positioning, options hedging, dealer inventory management, and mechanical selling when risk desks hit limits. When volatility spikes, margin requirements effectively rise even if official rules don't change. Brokers tighten risk, clearing firms demand more collateral, and overextended traders must find cash fast. That's when weird behavior happens. Long-term holders don't want to sell, but leveraged players have no choice. They sell the most liquid thing they own, often futures. That's why physical markets scream tight while paper dumps. Futures clear in seconds. Physical clears in trucks, vaults, and refinery schedules, different speeds, different rules. Example: if you're buying 1 ounce rounds or government coins, supply chains have bottlenecks. When everyone shows up at once, easy inventory gets bought and premiums rise. Screen price can be down while your checkout price is higher. In stressed moments, lease rates lift and the market pays more for metal now versus later. That's urgency. If you felt whiplash, you're not weak. You're watching a market go through a stress event. Stress events create the best information. They reveal where real demand hides and expose fragile parts of the system. Now let's talk about something bigger that connects to all of this: copper. While everyone stares at precious metals drama, copper sits like a coiled spring. If copper runs, it changes the inflation conversation and the hard asset conversation completely. Here's why this matters. The world is electrifying everything, and copper is the wiring inside that future. Demand projections out to the 2040s show massive growth. Some forecasts point to annual demand rising dramatically while supply struggles with declining ore grades and operational constraints. Even if economic growth slows down, infrastructure build-out doesn't stop. Data centers still get built, power grids still get upgraded, defense systems still get modernized, and energy transition projects still move forward. Now let's bring that back to gold and silver because there's a connection here. When the market gets hit with a sudden liquidation event, everything can drop together at first. Gold, silver, copper, whatever. If it's liquid and held with leverage, it can get sold. That's the sell what you can phase. Nothing is safe when margin calls hit. But the rebound phase is where you see the truth. The rebound phase shows you what people actually want to own when the dust settles and rational thinking returns. And that's why the physical demand story matters. If the sell-off was paper-driven and the physical market stays tight, screen price can snap back and premiums can stay elevated. That creates a weird feeling where people say price dropped, but it's not actually cheaper to buy. Have you seen that before? It's confusing the first time, but it's a pattern that repeats in stressed markets. Silver isn't just shiny metal people hoard. It's critical industrial input. Industrial demand is huge, and the market has been running deficits for years. Demand higher than supply. Deficits don't always show instantly in price. They're masked by inventories and recycling. But over time, sustained deficits tighten the system. When the system tightens, it doesn't take much. One strong wave of buying, one supply hiccup, one surge in industrial demand, and the whole market feels short on metal. Let me be skeptical. The phrase sold out everywhere is dramatic, but not always literally true. There are layers of inventory. When people say sold out, they mean popular products are gone, backlogs are growing, and premiums are rising. Easy supply is gone. Watch practical signs like product availability, wait times, and premiums. Now let's get back to the price action because this is where the next question sits. We saw the dump, we saw the bounce. The question is that bounce the start of a new leg up or is it a dead cat bounce before the next wave down? And the answer depends on whether the market can stabilize without crushing demand. If silver stabilizes and demand stays hot, you get a base. If silver keeps whipping around and premiums keep climbing, you get stress. And if you get stress, you can get another spike that shocks people who thought the story ended with the crash. Gold had its ugly moment too. The drop wasn't as extreme as silver percentage-wise, but it was still a big move for a metal usually treated as the calm adult in the room. And when gold moves like that, it tells you liquidation was broad, not isolated to just silver. But gold also has a different engine than silver. Silver is part monetary, part industrial. Gold is primarily monetary and reserve driven. That means when gold gets hit, it's often about dollars, yields, and positioning. So when gold drops hard and then steadies, that's when I start watching currency dynamics and real interest rates closely. Because if the market starts pricing an easier policy or weaker purchasing power, gold has a way of reasserting itself quickly. Now, I'm going to say something that might annoy both sides of this debate. Bulls want every drop to be pure manipulation. Bears want every spike to be nothing but a bubble. Reality is messier than either narrative. Yes, large players influence liquidity. Yes, derivatives amplify moves in both directions. But the deeper truth is that markets are complex systems, and the same move can have multiple causes working at once. A single drop can be forced liquidation plus profit taking plus general risk off selling plus a stronger dollar all happening simultaneously. So, what's the actionable insight here? In a high volatility environment like this, you can't just watch the price number. You have to watch the transmission mechanism. What's pushing price down? What's pulling it back up? What parts of the system are breaking under stress? Now let's talk psychology. After a crash, three groups emerge. Group 1 is traumatized and swears off metals. Group 2 is euphoric and goes all in. Group 3 is patient and waits for confirmation. Long-term survivors live in Group 3. If your heart rate is up, slow down. Decide your time horizon, what you own, and your goal. Same move means different things depending on your purpose. One more thread: liquidity and confidence. When assets drop sharply, people seek stability. Some run to cash, some to bonds, some to metals. Metals keep snapping back because the backdrop is unstable. High debt loads, persistent deficits. The appetite for real things doesn't disappear, it just moves around. That's why crashes and buying frenzies happen simultaneously. Silver bounced from low 70s to mid 80s. Huge move in short time. But rebounds after violent drops often create a trap. The first bounce can be short covering and bargain hunters. It feels like relief. Then the market tests lows again. The second test reveals if the market is healthy or fragile. This week, I'm watching whether the market can handle selling without collapsing. If it can, you get a base. If not, you get a second wave. What we know: violent sell-off, sharp rebound, physical interest, regional premiums signaling stress. What we don't know: will the market retest lows? Is more forced selling waiting? What's the next catalyst? Watch signals, premium behavior, delivery times, spreads, regional pricing, risk appetite. If you're holding metal after a huge drop, your brain screams at you to act. That's normal, but best moves happen when you're calm. Ask yourself, did your reason for owning metals change? If you own metals as a hedge, one ugly week doesn't erase that logic. If you're trading, your rules matter. In the near term, volatility stays high. Medium term, the market builds a base or retests lows. Long term, structural pressures remain. Industrial demand, deficits, desire for hard assets. Price won't go straight up, but the tug of war continues. Gold is insurance. Silver is insurance and raw material. When fear spikes, gold leads. When growth dominates, silver and copper sprint. You don't need to predict the next tick. Avoid getting emotional. If building long-term positions, scale in over time. If trading, respect volatility and size down. Sometimes the best move is doing nothing and watching signals. Let the market prove forced selling is done. Let physical prove tightness is real. If premiums stay hot while price stabilizes, that's when breakouts start. Here's the final thought. If silver can hold this rebound while physical demand stays hot, the next move could surprise people who got shaken out. But if the market is still clearing leverage and another wave hits, the next drop could scare the crowd one more time before the real trend resumes. Either way, this week is going to reveal what kind of market we're really in. This is Con Invests. Hit that like button, subscribe if you haven't, and I'll see you in the next one.